China has reason to be afraid of Bitcoin. China's widespread crackdown has sparked outrage in the Bitcoin community. China has emerged as a prominent player in this new financial ecosystem, and Beijing's measures may signal the start of a global regulatory assault on cryptocurrencies and crypto assets. This would be regrettable. While cryptocurrencies have a number of faults, the underlying technology holds tremendous promise. China formally prohibited initial coin offerings, the cryptocurrency equivalent of firms' initial public sales of stock. It then took steps to restrict the dealings of Chinese financial institutions with cryptocurrencies and crypto assets. The most recent shift is far broader. All cryptocurrency transactions within the United States are currently forbidden. In principle, such transactions can be carried out without the knowledge of the government. However, few Chinese citizens or financial institutions are likely to take the risk of incurring the wrath of the authorities. Beijing's moves demonstrate how national governments and central banks are growing increasingly scared of cryptocurrencies undermining their financial systems and wreaking havoc in other ways. They have a legitimate reason to be concerned. Bitcoin, the original cryptocurrency, was originally used to facilitate unlawful transactions on the dark web and is now used to facilitate ransomware attack payoffs. Meanwhile, it has become clear that Bitcoin does not function well as a medium of exchange for everyday transactions. Bitcoin's value is volatile, and the Bitcoin network is incapable of processing a high volume of transactions swiftly or inexpensively. Rather than that, Bitcoin has devolved into a merely speculative digital financial instrument with no fundamental value. The entire value proposition of this item is predicated on its scarcity. In contrast to fiat currencies, which central banks can print at whim, the computer algorithm that regulates Bitcoin issuance puts a hard cap on the total number of digital coins that can be created. Governments are concerned about the prospect of households investing their money in crypto assets, leaving them vulnerable to a speculative bubble crash. China's government clearly did not want any part of this, particularly given the backlash it is already experiencing for attempting to reduce the speculative bubble in housing markets that it fostered. Beijing was also concerned about the impact of cryptocurrencies on its control over domestic payment systems. This issue has been demonstrated by the government's attack on Ant Financial and other tech companies that have consolidated their dominance over domestic retail payments, rendering central bank money increasingly meaningless. Beijing is particularly leery of emerging cryptocurrencies known as stablecoins, which retain a stable value by being backed by fiat currency reserves and may be used in place of the same fiat currencies for payment purposes. Another concern was that cryptocurrencies and stablecoins could be used to circumvent international financial flow limitations. These restrictions have been loosened in recent years. However, the government is concerned that unrestricted flows will make managing the renminbi's currency rate more difficult. In 2015-16, as China attempted to rein in enormous capital outflows and contain a sharp depreciation of the RMB, demand for Bitcoin increased within the country as individuals used it to transfer money out of the country and circumvent official regulations. Beijing increasingly views cryptocurrencies as vehicles for capital control evasion. China has also targeted Bitcoin mining, the process by which enormous quantities of processing power are dedicated to validating transactions on the cryptocurrency's network in exchange for Bitcoin rewards. Due to the simple availability of inexpensive energy and computer gear, such mining has grown in China, making it the global epicenter of activity. Environmental consequences have been substantial in terms of energy use and computer trash. With the government in the middle of a power crisis as it attempts to wean itself off non-renewable energy, it was evident that Bitcoin mining would not be permitted. Despite these significant limitations, the blockchain technology that powers Bitcoin may really have widespread benefits. Already, the technology is finding applications in other facets of finance. Without the use of traditional intermediaries such as lawyers and real estate agents, it will soon be possible to undertake a wide variety of transactions, including the purchase of a house or car. Additionally, the rise of cryptocurrencies has led central banks to develop digital counterparts to their own fiat currencies. China has already begun conducting these experiments. Japan and Sweden have also done so, and a number of additional countries are likely to do so in the near future. Cryptocurrencies' future as financial assets is uncertain. However, the revolution they have sparked will make low-cost digital payments widely available. If permitted to develop further, these new technologies will also assist expand access to basic banking and financial services, including for low-income households and those underserved by established financial institutions. Advocates for cryptocurrency should take the appropriate lessons from China's crackdown. Rather of opposing regulation and oversight or saying that technology will enable the industry to self-police, they should collaborate with governments and regulators to develop effective legislation. As a result, the industry will gain increased credibility and stability. We hope you enjoyed watching and listening to this video. Please let us know your opinion in the comments area below. If you found our content useful, please like it and share it with your friends. Also, don't forget to subscribe to our channel and hit the notification bell for more crypto-related contents.